Everyone online is teaching you either smart money concepts or ICT. They make it sounds like a religion. You pick a side or you die on that hill. But here's what nobody's telling you. Both communities are arguing about the same market using different words. And the traders who are actually profitable in 2025, they stopped picking sides a long time ago. Today, I'm going to break down the real difference between SMC and ICT, expose what both get wrong, and at the end, I'm going to give you a straight answer on which one is more relevant right now. No politics, no guru loyalty, just the truth about how these markets actually move. Welcome back. This channel is about clean price action, honest education, and no hype. Let's get into it. First, let's be honest about where both of these came from. ICT, Inner Circuit Trader, was built by Michael Huddleston, who started publishing his concepts in early 2010s. His framework is deeply rooted in Wyckoff theory, Larry Williams' work, and institutional order flow. It's a specific proprietary system with defined vocabulary, fair value gaps, optimal entry rates, liquidity pools, power of three, kill zones. These are ICT's own terms, and he built them over years of screen time and observation. Smart money concepts came later, and here is the uncomfortable truth. The SMC community never admits. SMC is largely a repackaging of ICT concepts, stripped of some complexity, rebranded with slightly different terminology, and spread through social media by a second generation of educators. Order blocks came from ICT. Breakup structure and change of character variants of those ideas existed in ICT long before they became TikTok vocabulary. SMC is not a fraud, but it is a derivative. And knowing what changes how you should evaluate both. ICT's greatest strength is its depth. If you study it seriously, you are learning about how institutional algorithms hunt liquidity, how prices derive from one draw to another, and how market makers engineer moves to trap retail traders. This is powerful. The power of three concept accumulation, manipulation, distribution is one of the most accurate frameworks for reading intraday price behavior that exists in public trading education. Kill zones, the London Open, the New York Open. These are real, repeatable windows of institutional activity. ICT's material is genuinely advanced. But here is what ICT gets wrong, or at least what makes its danger from other traders. The complexity is a trap. Huddleston has released thousands of hours of content. The terminology is layered, sometimes contradictory across different years, and the community around it has turned into a cult of overanalysis. Traders are sitting on charts, trying PTRAs, identifying optimal trade entries, waiting for the perfect ICT setup, and missing clean, obvious moves that a simple price action reader would have taken. The framework is so large that it gives traders an excuse to always be waiting for one more confirmation. That is analysis paralysis dressed up as education. SMC gave an entire generation of traders a structured way to stop trading sport and resistance like it's 2005 and start thinking about where institutions are building a clear positions. But SMC has serious problem that nobody in that community wants to discuss. And it is this. SMC became a style before it became a skill. The community grew so fast on social media that the content became more aesthetics, clean chart setups, pretty annotations, followers, courses. The average SMC trader can draw an order blocks perfectly. They can label a liquidity sweep with beautiful lines. But when we ask them why the order block should hold, why is actually happening on the institutional side, they can't answer. They learned the tool without learning the theory behind it. And the tool you do not understand is just a drawing on your chart. The other issue, overuse kills edge. When millions of retail traders are all trying the same order blocks, making the same swing highs as liquidity, and waiting for the same break of structure signal, the market adapts. Or more precisely, the institutions and the algorithms that drive price already know these levels because they have created them. A concept that is taught on every trading TikTok account is no longer an edge, it's a trap. Here is the point of this video that I have not seen anyone else make, and I want you to sit with this. SMC and ICT are not competing systems. They are the same system at different levels of resolution. SMC is the 30,000 foot view. ICT is the ground level. The problem is that the traders in both camps are treating their YN as complete, and it is not. An SMC trader who sees a liquidity sweep and an order block has no understanding of kill zones of power of 3 is going to enter at the right location but the wrong time and get stopped out before the move happens. An ICT trader who understands the full model but is paralyzed by complexity is going to watch setups form and dissolve while they are still waiting for perfect alignment. The traders who are winning right now are using a synthesis, not the full ICT model, not basic SMC. They are using order blocks and fair value gaps together. They are using breakup structures for direction and kill zones for timing. They are using liquidity concepts for targets. They built their own trimmed down version of both frameworks. That is the real edge in 2026. For intraday scalping and day trading, ICT wins. The kill zone frameworks, the power of 3, understanding of how candles are constructed, these give you a timing advantage that SMC simply does not teach. If you are trading the New York session open on Euro USD or GBP USD, ICT concepts will serve you better. For swing trading on the 4-hour and daily, SMC's core concepts and cleaner and faster to apply. Order blocks on higher time frames still hold significant institutional validity. A clean supply zone formed by a strong bearish engulf on the daily chart with the liquidity sweep above a previous high, that is the high probability setup that does not require the full ICT framework to trade. For understanding market structure, ICT's explanation of how draw on liquidity works, how price is delivered from one pool to the next, is superior to anything SMC has produced. If you want to understand the why behind the move, study ICT. If you want a faster, cleaner checklist for what SMC gets you the quicker. So, which one is better in 2026? Here is my honest answer, neither alone. But if I had to put a trader in one framework from scratch, I would start them on SMC to build the visual vocabulary, the structure recognition, the ability to read the chart quickly. Then, once they are profitable at a basic level, I would introduce the ICT timing models, kill zones, power of 3, the liquidity delivery to sharpen their entries and deepen their understanding. The danger in 2026 is not which system you pick. The danger is going too deep into either one without trading a live account. Both communities are full of people who can annotate charts beautifully and have never held a winning trade for more than 2 days. The market does not grade your drawings, it grades your decisions. Simplify your model, define your rules, and put it in front of real price. That is the only test that matters. If this gave you a new way of looking at these two frameworks, hit the like button. It genuinely helps the content reach the traders who need it most. Drop in comments. Are you an SMC trader, an ICT trader, or have you built your own hybrid? I read every single comment and I want to know where you stand. Subscribe if you are new. We go deep on real price action every week, and I will see you in the next one.